financial counselors, and let's welcome him today.
Thank you. I'm going to be talking for an hour about financial planning and more specifically financial planning for physicians. I'd like to make this as informative and interactive as possible, so if I'm talking at any point, if you have a question, just raise your hand and we'll see if we can address it. I'm a certified financial planner. I've been doing this for about 6 years and work a lot with physicians and millennials with budgeting and wealth accumulation strategies. And so I thought I'd just like to give you guys an introduction to financial planning and more specifically cover some of the financial planning issues that affect a lot of physicians. So what is financial planning? Why is it important? And more specifically, why is it important to physicians? A lot of you guys, when you're graduating med school, are going to come out with a significant amount of student loans and start out at a pretty modest income. And so there's some budgeting and loan repayment strategies that are a little bit unique to physicians. Also, the profession is generally a little bit more at risk for a lawsuit than a lot of other professions. And so there are some asset placement techniques and insurance techniques to help you be covered from a liability standpoint. Try to break it out into planning during residency when times are going to be a little bit tougher, and then planning post-residency and beyond when you're going to be playing a little bit of catch-up. So what is financial planning? A lot of people misconstrue financial planning with just investing. Oftentimes I'll tell someone I'm a financial planner, and they'll say, oh, you know, what are your favorite stock picks? And I don't really do any stock picking. It's really a process of helping you achieve your goals through 5 key financial areas. And those areas are listed here on the PowerPoint: retirement planning, employee benefits, taxes, estate planning, risk management and insurance, and investments, which I'll get into in a little bit. There are 6 major steps in the financial planning process. Really the one thing you need to use this process is a goal. So does anyone have a financial goal that you'd like to share? Could be anything. Debt-free. Debt-free? Okay. So the thing a goal should be SMART, S-M-A-R-T. It should be specific, measurable, attainable, realistic, and it should have some sort of timeline. So your goal of being debt-free doesn't quite fit into the SMART, so let's go a little bit deeper. So when do you want to be debt-free?
By the time kids go to college, that way I can absorb that debt.
Okay, great. Okay, so we're saying what, like 15 years? 18? Yeah. Okay, so you'd like to be debt-free in 15 years. So we've done the first part of the financial planning process by establishing our goal. The second part would be to gather the data. So any pertinent data would be, okay, how much debt do you have outstanding? What's the interest rate on the debt? What's your income going to be after you graduate? What's your income going to be post-residency, right? We need that information to help analyze whether your goal is actually attainable. And once we have all the data, then we can go ahead and analyze and evaluate your status. So one thing we may find during analyzing your status is maybe you can achieve your goal in 10 years rather than 15, or you know, maybe it may make sense to switch to a different specialty that earns more money in order to, you know, achieve your goal in 15 years. The 4th step would be to develop a plan, and so that plan would be, okay, let's say you have private and federal loans, and you have 5 different loans. The plan would be, okay, you're going to pay your worst loans off first, and then once those loans are paid off, then take the, you know, whatever it was, $1,000 a month that you were paying towards the bad loans, and take that monthly payment and pay down some of the good loans. 5th step would be implement the plan. It's as easy as just actually making the loan payments. And then the 6th, and probably the most important step, is to monitor the plan and make any necessary adjustments. So usually when we do a financial plan, it's good for pretty much only the day we develop it and the person receives it, because things change. And so as you're going along, Well, let's say you have another kid. Well, that might change your goals and change your cash flow, and it might force the need for you to adjust your action steps and implementation steps. So why is financial planning important? Really, two main reasons. One is to prepare for anticipated goals, and I just listed the most common ones that I see. Paying off debt, purchasing a home, paying for kids' college, spending a certain amount a month during retirement, and leaving money to inheritors pain-free. Probably equally as important as planning for the expected is planning for the unexpected. And this is really more about the risk management and insurance. So you have to ask yourself the question, okay, what if I were to pass away? If I have a spouse or a family, is a life insurance product going to be able to replace the income that they have, or the income that I'm generating, or do I have too much life insurance, making me more valuable dead than I am alive? What if I were to become disabled? Good rule of thumb is to have 2/3 of your income covered under disability insurance. So financial planning will help address that need. What if I were sued? Do you have the right asset protection techniques in place to prevent you from a costly lawsuit? And then one covering investments. What if the stock market were to decline similar to 08, 09? Am I exposed from an asset allocation standpoint? And if I am exposed to a 40 or 50% decline, do I have the time horizon to ride out the ups and downs? So that's pretty much why financial planning is important to everyone. Why is it important to physicians in particular? I had alluded to this before a little bit. You face a unique set of circumstances throughout your career. Once you graduate, when you're a resident, many of you will be faced with a whole lot of debt with modest income and are going to need to prioritize your debt reduction strategies in conjunction with wealth accumulation strategies both during and after residency. Professions generally at risk for lawsuits, and then if you do decide to be involved in a smaller practice, or if you want to start your own practice, that's going to require a little bit more tax planning as well. So I'm sure probably the thing on the top of many of your minds is, okay, what do we do with all these student loans? I just pulled some figures from the American Association of Medical Colleges. The average indebtedness for med school graduates is a little under $170,000, which is a pretty eye-popping number. The current Direct Plus student loan rate is 6.41%. If you've taken them out in the past, many of you will have rates even higher than that. A lot of them are at 6.8% or so. Just the interest alone on a $170 loan, and that means you're just covering the cost of interest, not even paying down any principal. Using this assumption will cost about $11,000 a year. Okay, and average resident salaries vary between $45,000 and $65,000 a year. So the interest alone on an average med school graduate's student loans is going to be somewhere between 17 and 24% of your pre-tax residency income. So it's going to be a challenge during residency, and there are different loan repayment strategies that you'll be able to take advantage of. But at graduation, you definitely should have a plan in place to pay off all your debt. Paying off all the bad loans first, which I'll get into here on the next slide. So what's a good loan and what's a bad loan? Bad loans typically carry higher interest rates and are not deductible on your tax returns. So probably the worst type of debt you could get into is credit card debt. Those interest rates, aside from introductory periods, typically range between 15 and 20% per year. So if you have any credit card debt, that should be the first piece of debt that you should be aggressively paying off. Most auto loans typically carry higher interest rates, and again, they're not, the interest is not deductible on your tax return. And then some student loans aren't really that favorable. private student loans don't have as much flexibility as far as repayment strategy goes. Usually, if you have a private loan, once you sign up for the loan, the payment plan's been predetermined, and there's really no changing that unless you refinance or consolidate elsewhere. Some examples of good loans, which carry lower interest rates and can be deductible against your incomes, are two of them for homeowners are mortgages and home equity loans. So if you have a mortgage or home equity loan, you should be making the minimum payments on those, but probably shouldn't focus on aggressively paying those down. And then some student loans that are subsidized, or some of the federal student loans that have flexible repayment options are good loans to just make minimum payments on and then focus elsewhere on your repayment strategies. I just made a note here at the bottom. For student loans, the loan interest is only deductible on your tax return if your adjusted gross income is under $75,000 if you're single, or $150,000 if you're married. So, as I alluded to earlier, you want to pay off the worst loans first. One note I wanted to make is loan consolidation. It's a good idea in theory. The theory being, okay, I've got 12 different loans and I'm making 12 different payments a month. I just want to make one payment a month. It can make your life a lot easier, but it's going to cost you in the long run, and here's why. And I'll just use 3 loans as an example. So let's say you have 3 loans of $10,000 each, and one loan is at 0%, the other loan's at 5%, and the other loan's at 10%. If you consolidate these 3 loans, the company you're consolidating with is going to take the dollar-weighted average of your interest rates. So if you were to consolidate these 3 loans, you'd have one loan of $30,000 at 5%. What this does is it takes away your ability to aggressively pay off that 10% loan and make the minimum payments on your 5 and 0% loans. So loan consolidation can end up costing you in the long run, although it does make your life a little bit easier. I did want to cover all of the federal student loan repayment options. I'm sure many of you are already aware of. I'll cover the first 3 briefly because they probably won't make sense for you, and then I'll cover the last 2 in a little bit more depth. So the standard repayment plan, and again, for all these examples, I'm using the average debt, and I'm sure your guys's will vary significantly from this. But for someone with $170,000 of loans at graduation, that would, and again, the standard repayment amortizes the loan over 10 years. So the shorter your amortization period is, the lower the total payments of the loan are going to be. So annual payments of about $23,500, monthly payments of, yep. Oh, no, very good question. Amortization is just the process of paying down a loan. So the payment schedule, and typically when you're amortizing a loan, the payment is fixed. So you're paying a lot of interest at the beginning of the loan, and then at the end of the loan, you're paying a lot of principal. And so for the standard repayment, it's an excellent question. The payments throughout the entire loan, it's going to be a flat minimum payment, okay? And so for this example, your monthly payment for 10 years is going to be $19.61. No surprises, no fluctuation in your minimum payments. Total payments throughout the course of the loan is $235,000. Again, during residency, you're probably not going to want to be spending half of your pre-tax income. Again, this is before Uncle Sam gets his taxes. Probably not going to want to be spending half of your pre-tax income on loan repayments. I would say it's ideal for maybe someone who's married and receiving some support from a spouse, or if you just have a lot lower amount of debt than average. And I did make a note on the bottom here, for all of these different loan repayment strategies, you can make more than the minimum payment. So, for example, if you wanted to have your loan paid off in 8 years, you could bump your payment up to $2,300 a month. The minimum payment is exactly that. It's just the minimum that you have to pay. Extended repayment, this amortizes the loan over 25 years. So taking the same example and using the extended repayment plan, you're almost cutting your payments in half. Monthly payments are going to be about $11.51. However, the longer your amortization is, the more you're going to end up paying. So we saw here for the standard repayment plan, the total payments were about $235,000. You can see here for the same loan, by extending that repayment by another 15 years, you're increasing your payments to about $345,000. So this plan can give you a little bit more flexibility during residency by just giving you a lower payment, but I generally don't recommend this one for graduating med students, and I'll get into that a little bit later. Graduated repayment, I've never recommended this. I don't even really know who it makes sense for. The payments start out low, and then they are forced to increase every 2 years. I don't even know why it's an option, so I'm not going to really spend any time on that. These are the ones, and I know there's a lot going on here in this chart, but the two income-based payment plans are the income-based repayment plans, or IBR, and the pay-as-you-earn plan. I'm going to start at the bottom here and just go over what these plans have in common. So both of these plans are generally based on the amount of money you make, and they use that amount of money you make to determine the amount of it caps the amount of discretionary income that you can be spending on these loans. So for someone with high income or high debt and low income, this makes a whole lot of sense. One con of this is that to help the government determine your income, you have to file your taxes and submit paperwork every year for them to determine what your minimum monthly payment is. For a lot of people, especially at the beginning when your income's not as high, your minimum payment's probably not even going to cover your interest. And so one nice thing about both of these plans is the government's going to pay any unaccrued interest for up to 3 consecutive years, which is nice for when you're starting out. Both of these, you must demonstrate partial financial hardship by having high debt-to-income ratio. Again, the only real test you need to meet is this minimum payment that you're required to make under either of these plans less than the 10-year repayment plan. And if it is, then you're eligible for at least the IBR plan. And then here's where these two differ. So the income-based repayment plan has been around since 2007. And it doesn't matter when the loans were taken out. And it's available for direct and FFEL loans, which are family loans. And payments are limited to 15% of your discretionary income. After 25 years, if you're on the income-based repayment plan, and again, keep in mind that as your income goes up, so do your payments. So your payments are going to be super low during residency. And then once you move on to your career, your income is going to go up and so are your payments. And so that's going to force you to pay down the loans a little bit quicker. If the loans aren't paid off in 25 years, then the loans are forgiven. Typically, when I'm running projections, most people will have their loan paid off before 25 years just because their income projections they're expected to make a lot more over the next 10 to 15 years. But if your loan is forgiven, it's a taxable event, so just keep that in mind. So let's say at the end you have $50,000 left on your loans and you're in the 25% tax bracket. That's going to be taxable income to you, so make sure you have $12,500 set aside to pay the tax, which is that $12,500 is 25% of the $50,000. If you qualify for public service loan forgiveness, your loan will be forgiven in 10 years, which is nice. So that might be something if you're on the edge between working for and how many are serviced with the public, or how many of you are familiar with the public service loan forgiveness program? Oh, good amount. Yeah, if you're on the fence between working for a for-profit and non-for-profit, this will sometimes put people over the edge because it allows you to have your loans forgiven in 10 years. Now you can't have any late loan payments, and you have to be working for a non-for-profit consecutively for that 10 years. So if you start working there for 2 years, don't like it, and move to another company, well, that option kind of goes away for you. So keep that in mind.
Can you work for both a nonprofit?
Oh. Okay. So it's 10 years total? Oh, okay. Okay, 120 payments total. Okay. No. Oh, really? Yeah, and I will say this, and that's a good point. So, and I I haven't heard of that, and so I don't think it's been finalized, but I'm guessing that's just a proposal. So who knows how it's going to pan out. I will say this, both of these, or the income-based repayment plan and the public service loan forgiveness were instituted in 2007. So if you just do the math, not one of these loans has actually been forgiven yet, right? Because 2017 will be the first year that it happens. So who really knows? And so maybe just have that in the back of your mind that these rules are subject to change. The pay-as-you-earn plan. So we just covered the income-based repayment plan. The pay-as-you-earn plan, and I don't usually throw out blanket statements, but I will right now. If you can qualify for the pay-as-you-earn plan, you're going to choose that one 100 out of 100 times versus the income-based repayment plan. The minimum payments are less. They're limited to 10% rather than 15% of your discretionary income. The loan forgiveness is 20 years rather than 25. Now, who knows whether you'll have the loan paid off by then or not. More oftentimes than not, you'll have your loan paid off in 20 years. And then the capitalization of your interest is limited to 10%. So the government does pay for any accrued interest for up to 3 consecutive years, but if you're still going and still making the minimum payment and it's not covering your interest, the capitalization of that interest or the accruing of the unpaid interest is limited to 10% of your loans. Right. Okay. Guess there should be an asterisk next to that one. Teresa may be able to answer this better than I could.
What is your first and still apply?
Bless you.
Non-for-profit. Okay.
Yes. Only for the federal loans. Yeah, I believe it's just for the federal loans. They only look at the federal loans. Yes. Uh-huh. 24.
It says can be paid. Does that start counting from there?
I guess one thing I did forget to mention is that the pay-as-you-earn plan, it's only available for new borrowers. So you cannot have any outstanding federal loans as of 10/1/07, and your loans have to be loans that are eligible for this plan have to be taken out after 10/1/2011. So I'm guessing some of you may not be eligible for this plan. If you had any loan, the date you're referencing is 2011 or 2007? Okay. I don't know, to be honest. Federal. Yep.
Sorry, even if you paid off the check?
Anyone have any more questions? I think this was a pretty good slide, and you guys have an excellent resource here at UIC and Teresa, so I think she'll be able to answer any other questions you guys may have as your loans start coming due. So we've covered, to a certain extent, the loan payment strategies. One question I'll often get is, should I be, a lot of people say, okay, well, all my friends are buying houses, should I rent or buy during residency? Like most financial planning topics, it really depends on your situation. I would say more oftentimes than not, rent makes a lot more sense. Buying, because there are a lot of upfront costs and then costs at selling, it typically only makes sense to buy if you are planning on living there for more than 5 years. And so I know during residency, you could hop around, or after residency you may want to move somewhere else. So renting gives you flexibility, so you're not contingent upon the sale of a house if you want to move. You may want to consider buying if that's, you've determined, okay, this is where I want to be for 5+ years. Maybe you have stable income from a spouse that can help save for a down payment. And then one thing a lot of people don't really consider, that's actually pretty big, and it has really nothing to do with dollars and cents, but are you going to have time to maintain a house? And just think of this, when you're in residency, you're going to be working 60, 70, 80-hour weeks. Do you want it to be your problem when the furnace breaks? Or do you want to call a landlord and have them deal with it? So that's just one thing to consider when you're thinking about renting versus buying. The cost, I know there was a question beforehand about the costs involved in purchasing a property. Most of the costs for a home sale are incurred on the back end. So all of the realtor costs are typically paid by the seller. So the costs for purchasing a property itself are just going to be your down payment, the cost of an appraisal for the house, and then the loan servicing costs. I hope I was able to answer that question. And if you do choose to purchase a house, there are special loans for physicians that offer low or no down payment, no private mortgage insurance, and they relax their credit score and debt-to-income ratio standards just because they know what your earning potential is going to be post-residency. Typically, really the only caveat I see is that the interest rates are slightly higher than market rates, right? So they're taking the bank is taking slightly more risk by lending you money, and to compensate for that risk, they expect to receive a higher than average interest rate. Mm-hmm. No. Typically, when you take out a mortgage, you're locked in, and you can do an adjustable rate mortgage, but if rates go up, then your interest rate's going to go up, and if rates go down, your interest rates are going to go down. So you're locked into that interest rate, and the only way you can refinance typically is if you have 20% equity in the house. So under your scenario, you'd either be stuck living there and making that monthly payment, or you'd have to walk away or do a short sale or something like that. All right, retirement savings during residency. And I know there was a question about, okay, how do I juggle retirement savings and debt repayment? What should come first? And a general rule of thumb I like to use, and I know nobody here has a crystal ball, but if you think you can earn more than your interest rate by investing the money, then it makes sense to invest it. So for the example, if I have a student loan and the interest rate is 3.2%, for me, I think that's a pretty low bar to hurdle from an investment standpoint. So I think I could earn more than 3.2% a year in the stock market. So I'm going to invest that money that I could be using to aggressively pay down the loan, invest it in the stock market. However, let's say I have a loan at 6.8%. Well, that's kind of iffy. Could I earn more than 6.8%? Yeah. Is it guaranteed? Absolutely not. And by paying down your loan, what you are essentially doing is earning a guaranteed interest rate on your investment. So if you have a loan at 6.8%, the more you aggressively pay down that loan, the more you're able to earn a guaranteed 6.8% interest rate on that investment. So during residency, cash flow will probably be a little bit meager, and so I think just focusing on debt reduction would make the most sense, again, unless you have any free cash flow that you have to either save or aggressively pay down the debt. It does help to have a budget, and so if you don't have a budget, and I do, but if you don't have time to budget, I think there's a pretty simple method you can use, and that's what I call paying yourself first. And so when you get paid, you can actually direct your employer to put money in different accounts, and that way you don't actually even have to keep track of all of your expenses. You can have your debt servicing account, so you'll determine, okay, I need $1,500 a month to service my loans. Okay, have $1,500 of each paycheck per month go into that account. And then I have my fixed expenses, and so that's rent, utilities, to a certain extent groceries, things you need to survive. and then maybe another account is your fund money, right? And so that way, without consciously budgeting, if you run out of money on your fund money, then you're kind of saying, okay, well, is it really worth it to dip into my loan repayment bucket or my fixed expense bucket to achieve my goal? And obviously the other option is to get into more debt, and we don't want to do that. So that would be one way to budget without consciously doing it. There are dozens and dozens of software out there if you do want to actively budget. I use a program called You Need a Budget, YNAB. But Mint, Quicken, there are a bunch of different budgeting software out there that could potentially help you, especially during residency budgeting. So if cash flow is hindering your ability to save during residency, I would say try to the extent possible, if you can, to contribute to a retirement plan if your company offers a match. And so for the example I said earlier, and I said, okay, if my interest rate is 6.8% and I can earn more than that by investing in it, I'm going to invest. Well, if your employer matches dollar for dollar, you're earning 100% right off the bat, right? You put in $100, that 100 immediately turns into $200. So to the extent your employer matches, that's kind of a no-brainer. You should be contributing up to the percent that your employer matches. And then if you do have excess cash flow, if you have the choice between a Roth and a traditional IRA, I would 9 times out of 10 say that the Roth is probably a better deal. Are all you familiar with Roth versus traditional? And I can just kind of go over it briefly right here. So there's a chart. So when you contribute to a traditional IRA, and let's say your income is $50,000, you contribute $5,000. That will bring your taxable income from $50,000 down to $45,000. So you get a deduction going in. However, when you pull the money out, it's taxable. So let's say you're retired, pulling money out of your IRA, your income is $50,000, you pull out $5,000, it's going to take your income up to $55,000. Roth IRA, same example, earning $50,000 a year, you make a $5,000 contribution, nothing happens. You're still taxed at $50,000. When you withdraw the money, the withdrawals come out tax-free. So generally a rule of thumb I like to use is if you think you're going to be in a higher tax bracket when you're pulling money out, you should be contributing to a Roth, and because your income is going to be so low during residency, you're likely going to be in a lower tax bracket now than you will be when you're pulling the money out. All right, some post-residency planning issues. Most of you will be playing catch-up. So while you've been attending med school, and then over the next few years you'll be doing residency, a lot of your friends have been accumulating money and paying down their student loans. So you're going to be playing catch-up to a certain degree. However, that having a higher income can make that a little bit easier. Salaries starting out can range from the low 100,000s to the 800,000s and even more. Most of you will be probably in the lower end of that range, depending on if you decide to go into a specialty. I would say try to delay any big ticket purchases, so that Mercedes you've been dreaming about, and you think, okay, once I'm making, $150,000 a year, I'm going to buy this Mercedes. Might make sense to just start playing retirement and debt repayment catch up before you make that big ticket purchase. And then the first few years you can really start focusing on paying down your debt and saving for retirement. If you do happen to own a practice, that will allow you to potentially create some more customizable retirement saving plans to maximize your retirement contributions. Insurance, I'm just going to briefly cover insurance. So as I alluded to a while back, if you were to pass away, how would your family be able to run without your income? If you have a spouse that's not working or isn't earning nearly as much as you are, there's definitely a need for life insurance. There are 2 different types, term or whole. Term insurance. So as you age, your probability of dying increases, right? So a 20-year-old has a lot lower chance of dying than an 80-year-old. So as you age, the premium you pay per year is going to increase. What term insurance does is it takes the term, and you can choose 10, 15, 20, 30 years. And so let's say I choose a 20-year term insurance policy. It takes the average cost of my premiums over 20 years. So let's say right now I'd be paying $100 a year, and 20 years from now I'd be paying $600 a year. You're going to start off paying somewhere in the middle, maybe $200 or $300 a year, but you're locking in that rate for 20 years. Whole is a more permanent type of insurance. So if you think you're going to need insurance for longer than 10 or 20 or 30 years, it would make sense to use whole insurance. There are also some tax benefits of that, and I won't go into it into too much detail because the policies can get pretty complex. But I would say before just buying an insurance policy, make sure you just talk to an expert, and they'll be able to find a solution that's right for you. Disability insurance, make sure you have 2/3 of your income covered. A lot of disability insurance policies have caps. And most of them, or I should say most of them that are offered through your employer will have a cap. You should have 2/3 of your income, so if the disability insurance that you have doesn't cover 2/3, then it would make sense to go out and buy some more. Because you're going to be at a little bit higher risk of lawsuit than most, you should have professional liability insurance, which is in most cases covered by the premiums are covered by the employer. Personal liability and umbrella insurance are probably a must and are pretty inexpensive. You can have an umbrella insurance policy that covers up to $1 million of liabilities, and that would cost they typically see about $200 to $300 a year. So it's not very expensive. And then also from a risk of lawsuit standpoint, make sure your assets are titled correctly. And I'll just give one example. If you're a physician, let's say your significant other doesn't work, you're going to be a lot more at risk for a lawsuit, so it may make sense to title property in the spouse's name so a creditor would not have access to that property in the event of a lawsuit. And I put here, especially for insurance, every situation is a lot different, so I can't really throw out any blanket statements as far as, oh, well, term's better or whole life's better. I'd say just consult a professional to determine which and what type. Okay, so as far as finding a financial planner, I guess the first question is, do I need one? And I will compare financial planning to changing my oil in my car. So I'm not a big car guy, and I don't really have the time to learn how to change the oil. And I'm sure a lot of you are going to be working a lot and aren't necessarily going to have the time to dedicate to learning about financial planning, learning about investments, insurance, retirement planning, estate planning, all that kind of stuff. But more importantly, I think than time is, if I'm changing my oil and I don't know what the heck I'm doing, I can screw my car up pretty bad. And I think the same goes for your own finances. You know, if you're not an expert in this and you're not spending a lot of time doing this, you can really screw things up. So that's why I think everyone needs a financial planner. And then another common misconception is that it's only for wealthy people, which is far from the case. I think people with no net worth or negative net worth are probably in the most need of financial planning. So you should, if you have a goal or a financial question, you should be able to find a financial planner that can work with you. When you're looking to find one, look for credentials. At an absolute minimum, they should have the CFP, which is to obtain the CFP, you have to take 6 postgraduate classes, pass a 10-hour exam, fulfill a 3-year experience requirement, kind of similar to residency. And then we also have 30 continuing education hours per year. So it's kind of the gold standard in financial planning. If you're looking for someone with more of an investment specialty, look for someone with either a CFA or a CIMA designation. And then if you're looking for someone to help you out with taxes, along with financial planning, the CPA is the gold standard for taxes. There are generally 3 different ways financial planners are compensated. So commission, the advisor typically will generate a plan for you. Excuse me. Generate a plan, give you advice, and the way they're compensated is on the implementation. So they'll sell you a mutual fund or an insurance product and generate commissions, and that's how they're paid. Just know exactly what you're paying for. Fee only, which is what our firm does, I think is a little bit more transparent. So the advisor's paid a flat fee for service. So either a hourly fee or a flat fee to develop a financial plan. For managing assets, usually fee-only advisors charge as a percentage of assets. So if you have $100,000 and they're charging 1% per year, you're paying them $1,000 per year to manage your assets. Whereas a commission-based, and what are known as brokers, it's a little bit harder to determine exactly what you're paying for because the fees are embedded in commissions. And then fee-based is a blend of the two. So typically the advisor will do a plan, charge a flat fee, and then they can also generate revenue by selling insurance or mutual funds. So no right or wrong. Personally, again, this is why we decided to do fee only. I just think fee only is a little bit more transparent, and you know exactly what you're getting for what you're paying for. I just threw up a few links for some tools and resources. So the Financial Planning Association is the largest group of financial planners. There's a planner search that you can search for planners in your areas. I also included a tools and resources link if you want like a loan calculator or something like that. They have those types of things. And then the National Association of Personal Financial Advisors, which is a mouthful, so they typically go by NAPFA, is the Association for Fee-Only Financial Advisors. So if you're sold on working with a fee-only financial advisor, NAPFA is a great website to go to. So that pretty much wraps it up. I'll leave it open to any questions. I know there were some submitted before, and I can't remember if I got to them all, so please let me know if I didn't. In the front.
Are there any recommendations for
Mm-hmm. So disability insurance is typically covered by your employer, and disability insurance also you can't buy like 10 years worth of disability, so it's annually renewable. So there's really not much you can do to lock things in there, unless I guess the only thing I could think of is if you get disabled, you can't apply for disability. So I don't think there's a huge benefit of doing disability insurance now. Life insurance, the cost will be lower. I think the big question is, can you afford it now? If you can't and you put it off, it's really not going to cost you too much to delay it, right? So again, all that you're doing is kind of sliding your table forward a few years. So instead of being insured from age 26 to 46, you'll be insured from age 29 to 49. The costs don't really go up that much if you wait only a couple years. Sure, yeah. And so I guess one thing I didn't cover. So there are the 401k and 403b are what are known as employer-sponsored retirement plans. So those are sponsored by your employer. Hopefully they'll have a match to it. They're essentially the same thing. The 403b is for non-for-profits. and the 401k is for profit. So for all intents and purposes, they're the same exact thing. What makes them different from an IRA is you can hold your IRA anywhere. Your 401k or 403b is done through your employer, and they will pick a custodian and a list of investment options. The 401k also has higher contribution limits, so you can, at this point, contribute $17,500 a year to your 401k plan. You can only contribute $5,500 a year to an IRA. Follow up?
That means that
No. So the 401k is broken into two different components: your employer contributions and your employee contributions. Your employee contributions, you'll never lose those, okay, regardless of whether you terminate employment. The employer contributions, which are also known as the match, can be subject to forfeiture if you leave early. And they typically have what's known as a vesting schedule. So your employer will match, and let's say they put in $1,000, and that $1,000, and it's different for every employer, can vest over 5 years. So 200 of that each year will vest, and then let's say you leave after 5 years, then all of that is yours. Same exact rules. Yeah, I don't even know why they're titled differently. Yep. And so the way the 401ks work are the employer gives you a list of investment options, and they're required at a minimum to have 3: a cash equivalent, a stock index equivalent, and a bond equivalent. I've seen some with like 200 different options, which can cause some overchoice and complexity. But yeah, for Enron, one of the options was to put money in Enron stock, which I never recommend doing. Contributing, I try to recommend limiting your exposure to your own company to 5 or 10%, and the reason is you already have human capital exposure, right? So if that company goes under, you're out of a job. At least you can salvage something if they go under by having a diversified portfolio of other stocks outside of there. Mm-hmm. So a 457 is what's known as a deferred compensation plan. It's similar in the tax structure, but it's not subject to ERISA in the same rules. So 401ks and 403bs have to follow a certain set of rules to prevent. And this might get a little bit technical, but to prevent a plan from being what's called top heavy. So they don't want a company of 20 people to institute a 401k plan and have it benefit like the top 3 people in the company. So there are certain rules you have to follow. 457 plans don't have to follow those rules. And so you receive the same tax benefit. And do you know if they match? They don't match? Okay. And so if I would say if it were me and I had the option to contribute to the 457, I'd rather just make a traditional IRA contribution because the investment options are limitless and you're not getting a match either way. So you really have more control over your investments. Or I'm sorry, a Roth IRA. I guess with the one caveat of the Roth has a $5,500 limit. So if you want to contribute 20 grand, I would max out the Roth and then focus on the 457. There are calculators you can use. And again, that's why I always throw out the caveat, every situation's different. And I would either meet with a planner that can go over your situation or just look up like Roth versus traditional calculator. Because there is kind of an ancillary benefit of compounded growth. And the longer time horizon you have, the more sense it makes to contribute to a Roth. And so I would just plug your own situation into the calculator. I can't really make a blanket statement as far as which one's better. To Roth or traditional? So you can make a combination of 5,500 to both. So you can make 1,000 to a Roth and 4,500 to a traditional, or 2,500 to a traditional and 2,000 or 3,000 to a Roth. So it just, you have 5,500 to allocate between the two. You can, there are income limitations to being able to make traditional Roth IRA contributions. If you are covered under a retirement plan, so if you're covered under a 401k or 403b, your income, and I don't know the exact numbers off the top of my head, but your adjusted gross income to make a Roth IRA contribution, I believe, has to be under $180,000 or so, and that's for married filing jointly. And then for a traditional IRA, gosh, I think it's about $115,000. So be cognizant of where your income is. So there will be a point where the only way to contribute to a retirement account will be through a 401k or 403b contribution. And that was kind of a point that I had alluded to earlier, is if you're a business owner, you can construct a retirement plan to be able to sock a lot of money away, to the upwards of $50,000 a year or more. And so that is one of the benefits of owning your own practice, or having a say in which retirement plan your practice adopts.
If you're be allowed to have
Well, you can. I wouldn't recommend doing so, only because the limits are higher for the employee sponsored plan, and so that's going to allow you to sock away as much money as you can. So that's one of the big benefits of the IRA, and that's why a lot of people, and I know you probably see the commercials, roll your 401k over to your IRA. The big benefit of the IRA is when you're in a 401k, you have a list of 10 options, right? And those options could be good or bad, and they could be expensive or low cost. By using an IRA rather than a 401k, you have unlimited investment options, and you can choose really the best, lowest cost products there are out there. No, it doesn't. No, you can just roll it right in, and there's no impact on your tax situation in most cases. Typically, you have to be separated from service. So as long as you're employed with the same employer and you have that 401k, you can't. As soon as you terminate employment, then you can roll it into your IRA. That is well, that can be both. We've seen, actually over the last 2 or 3 years, a lot of 401k plans giving a Roth option. So if you, and not all of them do, but there will be a Roth option for a 401k, or there could be a Roth option. So if, let's say you were contributing 50% Roth, 50% traditional, and you wanted to roll it over, that would go into 2 separate IRAs. One Roth and one traditional. Mm-hmm. Um, that is, I don't know if I can make a blanket statement on that one. I will say this, and this is the way I looked at it. Well, one thing definitely to consider is, did you have a cosigner on any of your student loans? Because if you pass away, they could potentially inherit those loans. That would be one reason to have life insurance, is to say, okay, if I pass away, I don't want to leave mom and dad with $200,000 of debt. I should have life insurance to pay this off. If you have a mortgage on a house, I like to recommend just to have enough to pay the mortgage off. And it really all depends on your situation. Do you have kids? The way I looked at it was, we have a house, I'm married. I just said, I want enough in place for both myself and my spouse, if I were to pass away, to just give her 5 years and not have to worry about selling the house within 5 years. And hopefully by then she'll find someone, and someone a little bit better than me, and be able to live her life the way she wants to. But it really all depends on your situation. The one thing I would kind of caution is whole life insurance can be riddled with fees, and if it's too complex for you to understand, it's probably not a good idea to go into that product. There are whole life policies where they say, okay, you put $10,000 in, and of that 10,000, 200 is used to pay for life insurance, and then the remainder is invested in what's called a variable life insurance product. And then they have like these minimums and riders, and they say, okay, well, we'll guarantee that this earns 2% a year, but there's also a cap. And typically the more complex those policies are, the more expensive they are and the less worthwhile they are. For life insurance, for me and for what I recommend, I think simpler is better. And so if I more oftentimes than not will recommend term for that reason. So term, your rate is guaranteed for a certain amount of time. So let's say you have term insurance, and let's say you buy a 30-year term insurance and you're 30 years old. So you're covered until you're 60, at which point hopefully you won't have a significant need for life insurance, because hopefully your family won't be as reliant on your income as they are right now. Whole life is a permanent form of insurance, and so you will be paying a premium every month, but that premium does increase, and the insurance is available to you throughout the remainder of your life if you choose to keep making those insurance premiums. It's a little bit complicated, but the way whole life insurance works is you pay more than your minimum premium at the beginning. So let's say the cost to insure your life is $100 a month. You would pay something more than that. Let's just say $1,000 a month. So of your $1,000 a month insurance premium, $100 goes to pay the premium, and the other $900 gets invested, and it builds what's called a cash balance. And so each month you deposit $900 into this account, at which point in the future you can use that cash balance to assist you in paying the premiums. I hope I did a decent job of explaining that. It's a little bit complex, and a lot of times they're riddled with fees, and a lot of people who sell them receive big commissions. So I tend to shy away from recommending whole life unless there is a need for permanent insurance or tax savings, because there are some tax savings benefits as well. Okay, well, if you guys don't have any questions, it was a pleasure speaking today, and wish you the best.
Thank you.
Mm-hmm.